The global financial landscape is currently undergoing a violent transformation that most retail investors are completely unprepared for as we move into the first week of February 2026. While the headlines are screaming about a sudden stock market crash and the bloodbath in the crypto markets, the true architect of this chaos is operating behind closed doors in Washington, D.C., where the Federal Reserve has fundamentally changed the rules of the game. For over a decade, we have been addicted to the era of cheap money and endless liquidity, where every minor dip was met with a massive wave of central bank intervention. But those days are officially over with the rise of the Warsh Era. President Trump's nomination of Kevin Warsh as the new Federal Reserve Chair has signaled a shift so profound that it is effectively sucking the oxygen out of every speculative asset class from Mumbai to New York. You need to understand that this is not just another correction. This is a systemic revaluation of what money itself is worth in a world where the US dollar is reclaiming its throne as the undisputed king of all assets. Kevin Warsh is a name that every investor must now memorize because his philosophy is the exact opposite of the easy money policies that fueled the post-pandemic bull runs. Warsh is a hawk who believes that the Federal Reserve's primary duty is to protect the purchasing power of the dollar rather than the price of your stock portfolio. He views the massive bubbles in tech and crypto not as signs of progress, but as dangerous imbalances that need to be corrected through higher interest rates and a shrinking balance sheet. When the Fed signals that it is willing to let the market fall to kill inflation, the entire psychology of investing changes from growth at all costs to survival through liquidity. This transition is causing a massive liquidity vacuum, where institutional capital is being pulled out of risky emerging markets like the Nifty 50 and being parked in the ultra-safe, high-yield environment of U.S. Treasury bonds. The impact on the Indian stock market has been particularly brutal because we are seeing an unprecedented exodus of foreign institutional investors who are liquidating their blue-chip holdings at any price. For an FII, the calculation is simple. Why take a risk on an Indian tech company or a banking stock when you can get a guaranteed 5.5% return in U.S. dollars? This capital flight is putting immense pressure on the Indian rupee, which is now flirting with record lows against the greenback. When the rupee falls, India faces imported inflation, meaning we have to spend more for every barrel of oil and every piece of specialized machinery we bring into the country. This forces the Reserve Bank of India into a corner where they might have to raise domestic interest rates even if the economy is slowing down, creating a double-edged sword for the average middle-class Indian investor. If you look at the crypto markets, the situation is even more dire because Bitcoin has officially broken below its $75,000 psychological support level, which was supposed to be the floor for this cycle. The dream of Bitcoin as a digital gold that protects you from currency debasement is being tested by the reality that in a high interest rate world, Bitcoin behaves exactly like a high-risk tech stock. When the risk-off switch is flipped by the Federal Reserve, speculative assets are the first to be sacrificed on the altar of liquidity. We are seeing record outflows from Bitcoin ETFs as big money managers realize that the cost of holding a non-productive asset is too high when the US dollar index is climbing toward the 107 mark. This is a classic deleveraging event where the weakest hands are being shaken out by the sheer force of the strongest currency on earth. Perhaps the most shocking part of this February crash is the collapse of gold and silver, which were supposed to be the ultimate safe havens during times of economic uncertainty. In a normal crisis, gold prices should be hitting new highs. But in the Warsh recession, gold is being treated as just another source of liquidity. Investors who are facing margin calls on their stock and crypto positions are being forced to sell their gold holdings to cover their losses, leading to a synchronized crash across all asset classes. This is a rare phenomenon where nothing is safe because the US dollar is becoming so expensive that it makes every other commodity look overvalued by comparison. If you are holding physical gold, you must realize that while its long-term value is secure, its short-term price is being dictated by the desperation of traders who need cash to stay solvent. To truly see where we are headed, we must look at the yield curve, which has now reached its deepest level of inversion since the early 1980s. For the uninitiated, an inverted yield curve is the most accurate recession predictor in the history of finance, and it occurs when short-term debt pays more than long-term debt. This means the market is shouting at us that the immediate future is significantly more dangerous than the distant future. Every single time the curve has inverted this deeply, a global recession has followed within 12 to 18 months without exception. We are seeing the early signs in the manufacturing data and the cooling of the global job market. Yet many retail investors are still trying to buy the dip without realizing that the dip might actually be the beginning of a multi-year cliff. The political situation in Washington is only adding fuel to the fire as the looming threat of a U.S. government shutdown creates a sense of instability that the markets absolutely hate. While President Trump and PM Modi are signing historic trade deals to boost long-term cooperation, the short-term reality is one of friction and protectionism. Trump's America First energy policy is designed to bring wealth back to the U.S., but it does so by creating a stronger dollar that hurts everyone else's ability to compete. This creates a geopolitical tug of war where the Federal Reserve is pulling in one direction to kill inflation, and the White House is pulling in another to boost manufacturing. For you as an investor, this means you are caught in the crossfire of the two most powerful forces on the planet, and your only defense is a massive cushion of cash. We are also witnessing the great AI reset, where the massive valuations of companies like NVIDIA and Google are being questioned for the first time. The narrative that AI will solve every problem and generate infinite profits is being met with the harsh reality of high borrowing costs and diminishing returns on massive infrastructure investments. When money was free, companies could afford to spend billions on experimental tech. But in the Warsh winter, every dollar of capital expenditure must be justified by immediate cash flow. This is leading to a massive rotation out of growth and into value, as investors flee the tech giants and seek shelter in boring, stable sectors like healthcare, utilities, and consumer staples. If your portfolio is top-heavy with AI and tech stocks, you are currently holding the most vulnerable assets in the entire financial system. One of the most dangerous traps for investors right now is the dollar-cost averaging mantra, which works in a bull market but can lead to total ruin in a structural bear market. If the fundamental reason for an asset's price has changed, like Bitcoin losing its liquidity or a tech company losing its cheap debt, then buying more of it as the price falls is simply throwing good money after bad. You must have the courage to audit your portfolio and realize that the winners of 2024 and 2025 are very unlikely to be the winners of 2026. The game has changed from how much can I make to how much can I keep. And those who fail to adjust their mindset will be the ones who fund the profits of the elite who are currently sitting on the sidelines in cash. In India, the retail investor has become a major force through SIPs and direct stock participation, but this community has never truly experienced a prolonged high interest rate environment where the Fed is hostile. Most of the growth we have seen in the domestic markets was supported by a global wave of liquidity that is now receding like a massive tide before a tsunami. When the tide goes out, you finally see who has been swimming naked, and we are starting to see cracks in the over-leveraged small cap and mid cap sectors. These stocks, which were once the darlings of the retail crowd, are now seeing their trading volumes dry up as the easy money exits the building. This is a time for extreme caution and a return to the fundamentals of balance sheet strength and dividend yield. The Dollar King theory suggests that the DXY could potentially reach 110 or even 112 before we see any significant reversal. If this happens, the pressure on global commodities will be immense, and we could see oil prices falling even as geopolitical tensions rise, simply because the currency used to buy the oil has become so scarce. This is the paradox of a strong dollar recession. Everything becomes cheaper in dollar terms, but nobody has the dollars to buy them. For an Indian investor, this means your purchasing power is being eroded from both sides. Your domestic assets are falling in value, and the global products you want to buy are becoming more expensive because of the rupee's weakness. This is the ultimate wealth shredding machine, and the only way to beat it is to hold the currency that is doing the shredding. We must also discuss the psychological impact of this crash on the younger generation of traders who have only known a market that goes up. The diamond hands and hodl culture is being tested by the reality of a shrinking bank account and the rising cost of living. When your rent is going up and your crypto portfolio is down 50%, the pressure to sell becomes unbearable, leading to a capitulation event. This is the moment when the last of the bulls finally give up and sell everything in a panic. Historically, this is when the true bottom is formed, but we are not there yet. We haven't seen the level of total despair that usually marks the end of a bear market. We are still in the phase of hopeful buying and denial, which means there is likely more pain to come in the months of March and April. The strategic play for February is to become a capital conservator. This means you should stop looking for the next 100-bagger and start looking for ways to protect your principal. If you have profits in any sector, taking them now is not a sign of weakness. It is a sign of intelligence. The market will always be there and opportunities will always return, but your capital is finite. Once you lose 50% of your money, you need a 100% gain just to get back to where you started. In an environment where the Federal Reserve is actively working against you, the odds of making that 100% gain are slim to none. This is the time to build a war chest of cash so that when the capitulation finally happens, you're the one with the power to buy generational assets at pennies on the dollar. Looking ahead to the third quarter of 2026, the recovery will likely be led by companies that have zero debt and massive cash reserves. These cash-rich entities will be able to buy out their competitors for a fraction of their value, leading to a massive wave of consolidation across the tech and pharma sectors. If you want to be a successful investor during this transition, you need to think like a vulture. You need to identify the essential businesses that the world cannot live without and wait for their stock prices to be crushed by the general market panic. The winners of the next decade are being forged in the fires of this recession, but you will only be able to join them if you have the discipline to stay out of the way of the falling knives right now. The Warsh Winter is not just an economic event. It is a transfer of wealth from the retail public to the institutional elite who understand the cycles of liquidity. The Federal Reserve uses these cycles to reset the system and clear out the excesses of the previous decade. If you're frustrated and angry that your investments are falling, realize that the system is working exactly as it was designed to. It is designed to reward those who understand the macro picture and punish those who follow the crowd. By shifting your focus from the daily price action to the long-term movements of the US dollar and Fed policy, you are moving yourself into the top 1% of informed investors who actually stand a chance in this environment. Consumer psychology is also shifting as the high interest rate era makes buy now, pay later and easy credit a thing of the past. As the average person feels the squeeze, spending will drop and corporate earnings will inevitably miss their targets in the coming quarters. This will lead to a secondary wave of selling as the value investors realize that even the stable companies are facing a slowdown. This is the second leg of a bear market, and it is often the most painful because it kills the last bit of optimism left in the market. You must be prepared for this and not be fooled by bear market rallies, where the market jumps for a few days only to fall to new lows the following week. These rallies are designed to trap the dip buyers and provide liquidity for the big players to exit their remaining positions. The era of passive investing, where you just put money in an index fund and forget about it, is also under threat. In a sideways or falling market, index funds can go nowhere for a decade, just as they did in the 1970s. This is an active investors market where you must be selective and move between asset classes with precision. You need to understand the difference between a value trap, a company that looks cheap but is actually dying, and a value opportunity, a great company that is temporarily hated by the market. This requires deep research and a level of commitment that most people are not willing to put in, which is exactly why most people lose money in a recession. As we conclude this deep dive into the February market crash, remember that the most valuable asset you have is your ability to stay rational when everyone else is losing their minds. The headlines will get scarier, the predictions will get darker, and the pressure to do something will become intense. But often the best thing to do in a market like this is absolutely nothing. Sitting in cash is a valid investment position, and it is often the most profitable one during a structural reset. The US dollar is currently the most powerful force in the financial world, and until that changes, every other investment is just a bet against the house. Respect the power of the Fed, respect the strength of the dollar, and protect your hard-earned wealth at all costs. Generational wealth is not built during the easy times when everything is going up. It is built during the terrifying times when everything is falling apart. The people who bought the bottom in 2008 and 2020 are the ones who are wealthy today, but they only had that opportunity because they were prepared and patient. We are currently in the great preparation phase of 2026. Use this time to educate yourself, to build your cash reserves, and to wait for the perfect moment to strike. The market is a machine that transfers money from the active to the patient. And in the Warsh Winter, patience is your greatest competitive advantage. Stay disciplined, stay informed, and I will see you on the other side of this crash where the real opportunities await.